Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekly Update for the week of July 27th. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. As we do each week, Steve and I will be providing a brief update of the activity for the global capital markets in the week just ended, and we'll focus on a particular topic that we think could be of interest to our clients. This week, we are going to be focusing on gold and the role that gold can play in an investor's portfolio. But first, let's get caught up on the goings-on in the capital markets this week, because it was a very, very busy week. On Thursday of this week, the Commerce Department reported that GDP for the second quarter declined by minus 9.5%. That's the weakest three-month period of economic growth since they've been keeping track of that, and obviously a result of the coronavirus pandemic. People were expecting that number, though, and they knew it was going to be bad. But another number that came out on Thursday was from the Labor Department, which reported that continuing claims for jobless benefits in the U.S. increased by 900,000, and this number was not so expected by investors, and again, put in doubt the capacity for the U.S. economy to bounce back quickly and sharply. On Wednesday, the Federal Open Market Committee of the Federal Reserve made their announcement for their interest rate policy, and as expected, they left interest rates as they are, which is basically close to 0%. Jay Powell in his news conference, in his statement, and then in the news conference after the FOMC meeting, said a couple quotes that I think were interesting. One, he said the path forward for the economy is extraordinarily uncertain and will depend in large part on our success in keeping the virus in check. He also said, and I thought this was interesting because I think it shows that the Fed is really focused on the labor situation and the unemployment. Powell said that the pace of the recovery looks like it has slowed, and the labor market rebound is going to take a while. And then, interesting, I thought it was very interesting, at the end of that, he said, and we're going to be there for all of that. Again, a very strong signal from the Fed that they're going to do what it takes, particularly on the job front. Meanwhile, in Washington, D.C., negotiations for an additional economic stabilization package have stalled, and so what we may get from that is a temporary extension of the existing employment benefit package. In terms of COVID-19 here in the U.S., we're continuing to see new cases on a daily basis over the 60,000 mark, but it does look like there could be a trend down in that number of new cases on a daily basis. Lastly, we're in the middle of corporate earnings season, and yesterday was a big day as Apple, Amazon, and Facebook all beat analyst estimates in the second quarter. So with that out of the way, let me bring Steve into the conversation here, and let's turn our attention to gold as an asset class. And Steve, one of the reasons that we've chosen to talk about gold is we've had conversations with clients who are interested to know, since gold has appreciated pretty dramatically this year, is there any room left for gold to continue higher from here? But before you get to that, I think we should back all the way up, because there is talk, and there has been talk in the past, particularly from some financial professionals who question whether investors should ever own gold in a diversified portfolio. I know that we would disagree with that. Love to get your comments on that question.
Well, Fritz, the primary reason why some investors don't hold gold in their portfolios is because gold is an unproductive asset. It doesn't produce dividend income. It doesn't produce interest income. And over very long periods of time, returns from gold, from investing in gold, pretty much track inflation. And we know that over very long periods of time, equities do much better than inflation. So that's really the primary reason why some people choose to ignore gold. However, throughout history, there are several multi-year periods where gold greatly outperforms equities and every other asset class. Now, a reason to hold gold is that it is a store of wealth, just like cash is a store of wealth, paper money. And whether investors realize it or not, they either consciously or subconsciously make a decision for the money that they hold, the wealth that they hold that's not in stocks and bonds, they can either keep it in cash or paper money, or they can put it in gold as another store of wealth. And often people would put it in cash because cash earns interest. Gold does not. So it makes it an easy decision. However, while most of the time the interest that one earns from holding cash is greater than inflation, so your purchasing power is increasing, your wealth is increasing, there are times like today where the interest you earn from holding cash, from holding US paper dollars, is actually less than the rate of inflation. So your wealth is actually declining in terms of your purchasing power. Also, when you think about what store of wealth to use, you want to consider, well, which is the most valuable, rare form that you can depend on in the future? And when we think of how the Federal Reserve Board recently has literally printed trillions of dollars out of thin air, it's a reminder that the supply of paper dollars is variable, and it's at the whim of the central bank, in our case, the Federal Reserve Board. Whereas most of the gold that exists on planet Earth is already above ground, and the investable gold is in gold bars and coins, stored in central banks, commercial banks, investment banks, other storage facilities. And all the gold in the world is estimated to be worth about $9 trillion, which is far less than all of the stocks, bonds, and real estate in the world, which is in the vicinity of $600 to $700 trillion. And so if a lot of investors en masse decided to invest in gold, then they would all be competing with one another, bidding up the price. One other thing is that when you think about gold in the supply, you can fit all of the known world's gold supply, according to some estimates, in an Olympic-sized swimming pool or in a cube that's 20 meters by 20 meters by 20 meters. So it gives a tangible feel for the limited supply of gold versus the almost unlimited supply of paper dollars. Then finally, we advocate owning gold, at least a small amount, at all times, because it can be a hedge or an insurance policy against unforeseen events that could come out of the blue and hurt your portfolio, like a black swan, like a terrorist attack, or a geopolitical uncertainty, or closing the Straits of Hormuz where oil tankers go, or some other event that you can't predict in advance. But we know in those cases, gold acts as a safe haven. It can go up while your other investments don't do as well.
Excellent. So we know that throughout this year, we have been at or near our maximum range in terms of our gold allocations across the strategies that we manage that include gold. And gold has performed very, very well. In fact, during July, I believe gold bullion is up over 10% just on the month. And so that would be its best month in 8 years. So that's pretty impressive. And year to date, gold is up approximately 28%. So I think it would be helpful for clients to understand why, based upon our model research, we have been at or near our maximum ranges in terms of our allocations to gold this year. So maybe that would be something that you could cover.
Well, for several months, our model has produced a risk-adjusted projected return of gold that's been very high. And that's why for several months, we've not been at our minimum allocation, we've been at our maximum allocation and continue to be. Now, in our model analysis, we consider many important variables, but perhaps one of the most important we can illustrate in a slide that I'd like to share with everybody.
Great.
And visually, it shows what the quantitative models also show. There's a very strong inverse relationship between the price of gold and the level and change in real interest rates. And I want to explain what real interest rates mean. Real interest rates reflect simply the difference between your 10-year Treasury bond yield and inflation. And when you get a rate of return from owning that bond that's well above inflation, that's considered a high real interest rate. You're getting real money over and above inflation for owning that bond. On the flip side, you can have a situation where the rate of return or the interest rate is below the rate of inflation. That would be a negative real rate. And what the chart shows is it shows the incredible inverse relationship, almost like a mirror, between when the real interest rate is coming down, like it started high in the year 2000 and began a long descent down. Gold price moved in the opposite direction, started to climb. And it makes sense logically, because why hold paper money or a financial asset when you're getting less and less real return over and above inflation, when you can hold gold that at least keeps up with inflation and during multi-year periods greatly outperforms other asset classes. So what you see in the chart is you see how gold appreciated greatly from the early 2000s all the way up until the 2011 to 2012 timeframe. And the price peaked just as real interest rates bottomed out. When real interest rates climbed, gold fell quite precipitously. And then over the last several months, as real interest rates have fallen again, gold has climbed. And now we see real interest rates falling quite sharply. And this is, of course, due to the idea that the Federal Reserve Board, to try to help the economy, lowered interest rates to such an extreme degree and made a commitment to keep them low. And now interest rates are well below the rate of expected inflation. So our models are still positive on gold. Now, if you ask, well, what could change so that we would no longer find gold to be attractive? If all of a sudden inflationary expectations turned so negative that people expected a high level of deflation, then even with a low interest rate, the interest rate would be ahead of a low negative inflation or deflationary rate. Real interest rates would climb again, and then we'd be reducing our gold position. But right now, that's not happening. Right now, interest rates are well below expected inflation.
Right. So this brings me to a follow-up question maybe for that. And that is that many times if you hear from investors or investors assume that, oh, the reason that you own gold is because it's a good hedge against inflation. But I know that it's far more complicated than just being a hedge against inflation. And maybe that doesn't necessarily hold. So could you comment on that?
Sometimes when people think of gold as just an inflation hedge, it doesn't really do gold justice, because by the time the inflation comes, gold is most likely already appreciated well ahead. And gold is a great leading indicator, not only of inflation, but also of the loss in purchasing power of a country's currency. So while sometimes inflation happens because an economy overheats and too much money is chasing too few goods and wages are going up, well, that's one cause of inflation. And people say, well, that's not going to happen anytime soon. Another cause of inflation or losing purchasing power is when your currency begins to get weakened. And as we just saw in the last few weeks, we saw how the Federal Reserve Board could print huge quantities of US paper dollars, trillions of dollars worth, in a very short time period out of thin air. Makes people question the value of that currency. And as we saw in the last few days and weeks, the value of the US dollar has been coming down. So gold, yes, it could be an inflation hedge, but it's an early indicator, and gold can do well in other conditions. It can do well if deflation becomes such a worry and interest rates aren't already low and people think the Fed's going to lower rates sharply to get ahead of the deflationary pressures. Gold can do well in terms of geopolitical uncertainty and other things that don't directly affect inflation in the short term. So gold is much more than just an inflation hedge.
So Steve, thank you very much for this. I think that it's very helpful because gold has always been an important part of our multi-asset diversified portfolios. And so I think it's good to shed some light on exactly why that's the case. So that will do it for Steve and I, and we'll be back next week with another edition of our 3EDGE Weekly Update. Remember that all of our videos are available on our YouTube channel, and please, we invite you to subscribe to that channel, and always feel free to share our videos with someone who you think might be interested. And in addition, if you have any questions or suggestions for a future topic, please send those along to us at our website at 3edgeam.com. So on behalf of Steve and everyone at 3EDGE Asset Management, we urge everyone to stay safe, stay healthy, stay strong, and to keep the faith. And Steve, thank you again for your time and your valuable insight.
Thank you, Fritz.
And thanks to all of you for listening.